Have you ever been told that Roth conversions are only for young people? Like, if you're past 70, that ship has sailed, just forget about it. Yeah, that's bad advice. And today, we're calling it out. Because here's the thing nobody's telling seniors. There are actually some really solid windows after age 70 where converting your traditional IRA money into a Roth is not just smart, it's kind of a no-brainer. We're talking protecting your family, dodging unnecessary tax bills, and keeping more of what you worked your whole life to save. Hey folks, welcome back. I am Imran, teach finance courses and data analyst. Today, we're busting a really common myth that Roth conversions stop making sense once you hit your 70s. Spoiler alert, they don't. In fact, for the right person in the right situation, doing a Roth conversion after 70 could literally save your family tens of thousands of dollars, maybe more. Now, I'm not saying everyone should run out and do this tomorrow, but there are 5 specific situations where it genuinely makes sense, and by the end of this video, you'll know exactly which ones might apply to you. Let's go. All right, first one, and this happens more than you'd think. You had a weirdly low income year. Maybe you retired and the paychecks stopped. Maybe you had a big medical expense that wiped out a chunk of your taxable income. Maybe your investments didn't pay out like they normally do. Whatever the reason, your income dropped, and that's actually your golden moment. Here's why. The IRS taxes your Roth conversion like regular income. So if you're sitting in a lower tax bracket than usual, say 12% instead of your normal 22%, you can convert some of that traditional IRA money and pay taxes at a discount. You're basically shopping for tax rates, and the sale just started. Think of it like this. Your traditional IRA is a bill you haven't paid yet. Every dollar in there, the government is going to want their cut someday. The question is just when and at what rate. A low-income year gives you a chance to settle that bill cheap before the price goes back up. So if you had one of those quiet years financially, don't just shrug and move on. That's your window. Use it. Okay, number 2. This one is huge, and most people totally miss it. If you're between 70 and 73 right now, listen up, because you're sitting in what I call the sweet spot. Your required minimum distributions haven't fully kicked in yet. RMDs, for anyone new to the term, are basically the government saying, hey, you've had that IRA money sitting there long enough. Time to take it out and pay taxes on it. Now, quick note here. Under current rules, most people start RMDs at 73, but if you were born in 1960 or later, your RMD age is actually 75, so your sweet spot window might be even longer than you think. Either way, double-check your specific number with your advisor because it genuinely matters. Here's the point, though. Before RMDs kick in, nobody's forcing your hand. So what you want to do is convert some of that money into a Roth on your own terms, at a pace you choose, in a tax bracket you manage, so that when RMD time does arrive, the balance in your traditional IRA is smaller. Smaller balance means smaller forced withdrawals. Smaller forced withdrawals means smaller tax bills every year for the rest of your life. You're basically getting ahead of the game before the government shows up and starts calling the shots. And trust me, you want to be the one driving that car. This next one is really important, and I wish more people talked about it, especially married couples. When 2 spouses are alive and filing jointly, you get access to wider tax brackets, more breathing room before you jump into that next tax rate. But here's what a lot of people don't think about. When one spouse passes away, the surviving spouse now files as a single person, and single tax brackets are way tighter. Income that was coasting along at 12% can suddenly get hit at 22% or even higher, just like that. No warning, no adjustment period. Now imagine your spouse passes and you're suddenly a single filer with a big traditional IRA throwing off income every year. Every RMD you take is getting taxed at a higher rate than before. That's a rough situation to be in, especially when you're already dealing with so much else. Here's where the Roth conversion comes in. If you convert while you're both still alive, while you're still in those joint filer brackets, you lock in the lower rate. You pay the tax today at the cheaper price, so the surviving spouse doesn't get slammed with a bigger bill down the road. It's honestly one of the most loving financial moves a couple can make, planning for each other's future, not just your own. Let's talk about your heirs for a second. Your kids, your grandkids, whoever you're leaving things to. Here's the deal. When you leave someone a traditional IRA, under current rules, they have to take all that money out within 10 years, and every single dollar they pull out gets taxed as ordinary income. If your kid is in their peak earning years, already making good money, already in a higher bracket, they're going to get hit hard on that inheritance. Could be 24%, could be 32%. Ouch. But a Roth IRA, they still have to take it out within 10 years, yeah, but it all comes out completely tax-free. Every dollar goes to them, not to the IRS. One thing worth knowing here, there's a 5-year rule on Roth accounts. Basically, the Roth needs to have been open for at least 5 years for your heirs to get the full tax-free benefit on the earnings. So the sooner you open or convert, the cleaner and simpler it is for the people you're leaving it to. Don't wait on this one. So when you do a Roth conversion now, even if it costs you a little in taxes today, you're prepaying the tax bill so your family doesn't have to. You're leaving them a cleaner, richer gift. And that's what most people actually want when they think about leaving something behind, making things easier for the people they love. Okay, this last one is sneaky, and it catches a lot of people completely off guard. It's called IRMA, which stands for Income-Related Monthly Adjustment Amount. I know, total mouthful. But in plain English, it just means this. If your income is too high, Medicare charges you extra every month. Not a little extra. We're talking hundreds of dollars more per month in premiums just because your income crossed a certain line. And what drives that income number up? Big RMDs from your traditional IRA. Every year, those forced withdrawals get added to your income, and if they push you over the IRMA limit, your Medicare bill goes up. Now here's the play. If you do Roth conversions earlier and shrink your traditional IRA balance, your future RMDs are smaller. Smaller RMDs mean lower reported income. Lower income means you stay under those IRMA thresholds. And that means you're not paying hundreds of extra dollars every month just to keep your Medicare coverage. One heads up though, and this is important, the conversion itself adds to your income in the year you do it. So if you convert a big chunk all at once, you could actually trigger IRMA that same year. The smart move is to spread the conversion out over several years, staying just under the threshold each time. A good financial advisor can help you map that out. Lower taxes and lower Medicare bills over the long run, that's the double win right there. Completely legal, totally above board, and one of the smartest long-game moves a senior can make. So let's do a quick real talk recap. A low-income year? That's your discount tax window. Don't waste it. Between 70 and your RMD age, whatever that is for you, you're in the sweet spot. Convert on your own terms before the government starts deciding for you. Married couple worried about the surviving spouse? Convert now while those joint brackets are still working in your favor. Leaving money to your kids? A Roth is a far cleaner, more generous gift than a fully taxable IRA. And Medicare premiums creeping up on you? Shrink those future RMDs and protect your monthly budget for the long haul. These are not loopholes or tricks. This is just smart, thoughtful planning, the kind that takes a little effort now and saves your family a whole lot of headache later. And look, everyone's situation is genuinely different. Please work with a qualified financial advisor or CPA before making any moves. What works beautifully for one person might not be the right fit for another, and the details really do matter here. But hopefully today cracked open the idea that the Roth conversion conversation doesn't end at 70. Sometimes, for the right person in the right situation, that's actually when it gets really interesting. If this helped you even a little bit, hit that like button. It genuinely helps this channel reach more people who need to hear this stuff. See you in the next one. Take care of yourselves.